Let's start with our favorite couple of words of the week, inverted yield curve, right? For the second time this year, we've seen the yield on the 10-year fall below the yield on the 3-month. Is this concerning? Is this the prognosticator for recession, like so many people are saying?
Where I think the concern is there's a widely held belief that the bond market knows things before the stock market does. And that's why the inversion that continues to happen and kind of knocking on the inversion's door with the 2 and 10 as well has been concerning for stock investors. And there's also a belief that I would subscribe to somewhat that yesterday's sell-off was due to the inversion and that assumption. An inversion is definitely important when we look at it for, I guess, predictive reasons, usually in the 2s, 10s, however, and that has not happened yet. And the other thing is you don't really know that an inversion predicted a recession until we're already in it or maybe through it, right? So by the time we know that an inversion was meaningful to watch, we're probably 18 months down the road and coming back out of a recession and starting our next expansion.
What are your thoughts?
Yeah, I mean, in general, the last 2 recessions have been preceded by inversions, so they are a good signal. That being said, the lags are long and variable. They can be anywhere from 6 months to 3 years. So it doesn't necessarily mean that because we see an inversion, we're necessarily going to be in a recession tomorrow. And I think what we're seeing is essentially this pricing in of slower growth ahead. And this is expected as fiscal stimulus dissipates from the economy and as these trade tensions ramp up and as markets come to the realization that tariffs are not going away tomorrow, that yield curve inversion becomes almost natural.
Let's play hypothetical. Let's say we do enter a recession first quarter of 2020. What does that look like? I don't suspect it will look like the 2008, 2009 recession. Do we lose 10,000 jobs a month? What does it look like to you?
Well, I think we could have a garden type variety of recession if we enter a recession in 2020, in early 2020. We wouldn't probably see the freezing of credit intermediation that we saw in the Great Recession. So we wouldn't expect as much of a deep recession that we saw back then. Do you
still get job losses?
You could potentially get job losses. We've had job gains for 100 consecutive months. That's the longest stretch on record. In June, we'll reach the longest expansion ever for the U.S. economy in terms of GDP growth. So we are in this environment of a prolonged business cycle, and some losses in jobs wouldn't be that surprising as we see this labor market maturing and we push down further on the unemployment rate.
Liz, you say that a correction without a recession is a buying opportunity. So if that's the case, where are those opportunities?
Well, I want to back up and speak to the conversation that we just had. If we see a recession that begins in the first quarter of 2020, that means that we're starting to see negative growth at the end of this year, which would be a pretty big move downward, and the market would hate that. So I don't see that happening. I think a recession that would signal the first quarter of 2020 is probably hard to see coming. It depends on what causes it, however. So if we have another time like the fourth quarter of 2018 where sentiment completely falls off a cliff, coupled with a government shutdown, coupled with trade fears, and if we still have tariffs on and leading economic indicators start to turn sour, then maybe. But I completely agree with Greg that either way, it's not a deep recession like we had in 2008, 2009. So this would be more like .com 2.0, not financial crisis 2.0.
Somewhat encouraging.
Somewhat encouraging, right? And you have to remember, I mean, I don't want to overly simplify and I don't want to make light of it, but recessions are natural, healthy movements in an economy. There will be one at some point again. We will survive it again. And hopefully it's not a huge global financial crisis like we had in 2008. But now to your point.
How do you insulate yourself if that's going to be the scenario or could be the scenario?
If we look at a yield curve as the predictor, if we look at economic numbers as the predictor, if we look at the market as a predictor, you still don't want to get out of the market prematurely because already this has been the most hated bull market. We are in almost the longest expansion and the longest bull market, and not everybody has participated in it. And even after 2018, when we had that big scare, so many investors took their money out of the market and didn't put it all back in the first quarter. So they missed that double-digit leg up in Q1. So you want to make sure that you're balancing the near-term headwinds, so not being overweight beta, with still being able to participate because you must be present to win.
And here we have the opening bell at the New York Stock Exchange and the NASDAQ, and it looks like calmer heads are prevailing on Wall Street today. We saw the futures up slightly. The Dow Jones Industrial Average going to start the day up 12 points.
You know, Liz, I think it's very important where we talked about earlier in the show, this concept of fragile market. Can you invest successfully in a fragile market, or do you just have to become a day trader?
Please say no.
Yeah, I never. I would never suggest anybody become a day trader. It's impossible to time the market. And if you find somebody who knows how to do it, please let me know. I'm happy to invest with them. But it's a really difficult thing to do, especially in fragile markets that are driven by headlines. That is a losing game. If you're trying to predict the next tweet, if you're trying to predict the next fear that's going to bubble up out of somewhere that we're not even watching, chances are the next big thing that happens is something that we're not even talking about today. So day trading is probably not the right way to go about it. How do you invest in a fragile market, though? First of all, what you want to do is make sure that you're participating in it, right? I mean, cash and short-term bonds are effective in holding their value, but they're not effective in lowering the correlation of the overall portfolio. So you have to make sure that you're balancing beta with something that's actually going to do that, like traditional duration, like alternatives. And that way you can still take part in up markets that happen on the beta side, on the equity side, but you have the right type of protection that's going to actually zig when the other part zags.
I want to get back to your conversation about the Fed earlier. Yeah. So it looked like the market was starting to price in not just one cut in interest rates this year, but possibly two. You're looking out to 2020, though, for any activity from the Fed. Why?
Well, I think if we look at the broader conditions and the Fed's stance, the Fed has adopted a clearly more dovish stance since the start of the year. The dovish pivot that we saw in January has permeated through the rest of the Fed's thinking. And if we look at economic conditions and if we look at the inflation undershoot, we think that the Fed is likely to cut rates in early 2020. And I think that's very important in the context of this whole discussion about a recession. I don't necessarily see a recession happening, in part because I think the Fed is going to be much more dovish than in prior cycles. And if the Fed does proceed with a rate cut, that would provide additional accommodation to the economy and potentially to markets at a time when growth is slowing.
Now, Greg, outside of the daily news, how worried are you about the next debt ceiling debate and that raising credit costs, and we're back at that whole struggle that we saw a couple years ago?
The whole debt ceiling argument is a little futile, if you ask me. You have two rules that have to be respected. You have the budget that has to be voted by Congress and approved by Congress, and you have the debt ceiling. They both end up meaning the same thing. So by voting a budget, you're implicitly determining a certain amount of debt. So that whole debt ceiling, I think, is a little overdue, and we know that no party has ever won that debt ceiling debacle or crisis when we look back at 2011, 2013. So I don't necessarily think it'll be a big issue, but it will be the case that we'll go into the last minute probably until we raise this debt ceiling.
Shocker there, right?
Probably late summer by the time we get to a deal on the debt ceiling.
We've seen that story before. Let's talk some sectors, because semiconductors were killed for most of the month of May, especially because of a lot of their exposure to what's going on with China. But yet we saw yesterday, and we were talking in our morning meeting today, how they actually held up pretty well yesterday. They're starting to come back. Do you think the selling in semis is overdone? Is this now an attractive place to move in?
I think what it tells us is that there is no clear pattern, and this is why you don't want to be a day trader. There's not a pattern that says, okay, we are in a risk-off environment, so defensives are leading, and they were up until yesterday. Defensives are leading, and then we had a drawdown, and defensives were hit the hardest, which made really no sense at all, and it was during a period when yields rallied. So I think what it tells us about, number one, semiconductors or even the tech space overall, and then goods producers and even retail, is that those are the spaces that are going to get hit with tariffs, and they're probably the most sensitive to that headline risk. So as we move through this, are we going to get a deal? Are we not going to get a deal? Those are the spots that I would expect to see more volatility, both on the upside and on the downside.
Now, how worried are you about the move in bank stocks? Obviously, they're getting hit because of the fall in rates, but doesn't that read through to an economic message as well?
So I am going to start sounding insane because I continue to say that I like financials. And I do still like financials. They're better capitalized than they were pre-crisis. They're better capitalized than European financials or really any other international financials.
There's definitely a case to be made.
They are sensitive to the yield curve. And in a time when we have an inverted curve on the 3s, 10s, you have to remember financials lend long and borrow short. And if they're not going to make money on that long end of the curve, investors are going to see that. They're going to worry about margins. They're going to worry about cost pressure. There's cost pressure, however, across the board. And I still think financials can hold up better to that. And if you look at financials as a way to play the U.S. economy, I know the U.S. economy is slowing, and I absolutely agree with that. But it's still slowing less than other economies, and we continue to be a bright light in a dim room.
I think Liz brings up a good point. In this environment where you're having the inverted yield curve, if the yield falls, say, another 5 basis points, what sectors are a good place to be hanging out in at that point?
I think you want to be careful how you allocate your money and act in that way. I think in general, when you're looking at the broad economy, you still have that positive momentum. And we can't just assume that a recession is the next step. I want to be very clear on that message, is that we still have moderate growth. The economy is still advancing at a 2.5% pace. We're still producing jobs at a clip of 200,000 every single month.
So weak durable goods don't bother you too much?
They do bother to some extent, but we know some of the root causes. We know that trade tensions are partially to blame for that. We also know that the auto sector, for instance, was one of the prime sectors to rebound following the Great Recession. And now we're seeing some plateauing, some maturing signs in the auto sector. So I do caution that we have to be a little bit careful with this view that everything's going to turn bad all of a sudden. There are still some pockets that are good. Consumers are still spending at a fairly decent clip. Those sectors are still doing relatively well. They are exposed potentially to blanket tariffs from the U.S. administration on all imports from China. Consumer goods are very much exposed to that risk. But overall, I think that there is still that sentiment that we have some positive gains out there.